Hi everyone, this is Jadu from Property Frameworks Buyers Agency, and today I want to talk about the performance of our capital cities and what we could see in terms of price growth for our capital cities for the next 2 to 3 years, or rather the short-term performance of these capital cities. So first, let's look at this chart from Matusik, which shows the correlation between housing finance and house price growth. So the black line is the housing finance. So whenever the black line is at higher than this line here, for example, in this case, it's at 40%. This means that lending restrictions have eased and it's more easier to borrow money. And whenever we have this kind of situation, you see that house price growth also occurs. At the same time, when there is uh, a decline in the housing finance, the price growth follows. There is a decline in the house price growth as well. So if you look at the current scenario that we are in 2022, 2023, we know that in 2021 there was a massive increase in the housing finance. It was really easy to borrow money. And in fact, it had increased by around 80%. And that's why we had that massive boom in Australia, which had a massive increase in house prices. But now we know that we are in a very interest rates have been increasing continuously. Lending restrictions have been put in place. It's much more difficult to borrow money, and we all know that there has been a decline in the house prices in general. So which of these cities have been affected by these changes in the lending restrictions? Let's just go into the second chart to have a look at this. So this is a chart from Corelogic, which shows the performance of the capital cities up till February 2023. So we are looking at the past 12 months. So what we can see here is that the cities that are heavily impacted by the changes in the lending restrictions, by the increase in the interest rates, are mainly Sydney, Melbourne, and Brisbane, and Hobart and Canberra to some extent. Perth and Adelaide have still been immune to these changes in the lending restrictions, and they have still performed quite well. 5.1% increase in Adelaide and 2.4% increase in Perth. So looking at this data, this shows that when the lending restrictions ease and when it becomes more easier to borrow money again, these capital cities, mainly Sydney, Melbourne, Brisbane, are going to have a rebound. They're going to come back. So to what extent are they going to come back, and which capital cities are actually going to perform well? To understand this, we need to look at the supply demand factors in all these capital cities, and that's why we have this third chart from Matusik. And I think this is a very good chart which shows the supply and the demand and what we can expect in terms of prices moving forward. So let's start off with Sydney. So population growth in Sydney is forecasted to be 86,536. The housing demand, the housing number of houses needed to accommodate all these people is around 41,208, assuming that about 1.9 to 2.1 people live per dwelling. So the number of dwelling approvals in the pipeline is 104,500, which means that there is an excess supply of 63,292 homes, which and this is about 18 months worth of supply in Sydney. In Melbourne, it's 25 months. In Brisbane, it's 3 months. Adelaide has 9 months. Perth has 2 months. Hobart, 2 months. Darwin is 0, and Canberra is 26. Now, if you look at Brisbane and Perth, they only have 2 months of supply left in the pipeline. Okay, considering their population growth and the number of houses that are being built. Adelaide has 9, which is still not too bad. But Sydney and Melbourne, you can see that they have 18 and 25 respectively. So there is a lot of supply there when all of these houses eventually get built out. So what does that mean? It means that Perth, Adelaide, and Brisbane has a shortage of stock. And that means that there is going to be some kind of price growth within the next few years in these cities because demand would outstrip supply at some point. In Sydney and Melbourne, it doesn't seem to be the case because we do have 18 and 25 months of supply in the pipeline there. Of course, there are markets within markets, so there could be still some markets in Sydney and Melbourne that could perform well. Okay, let's look at one more chart to forecast what could happen with the capital city prices. Now, this is again a chart from Matusik, and this shows the current median prices of all the capital cities and the sustainable price point. So, the sustainable price point is calculated given the median income of people in the cities and what they can actually afford. So you can see in Sydney, it's well over the sustainable price point by 21%. Whereas in cities like Brisbane, Adelaide, and Perth, they're all under that sustainable price point. Especially Perth, look at this 622,000 median price in Perth, and the sustainable price point is 825,000. Which means that people could afford up to 825,000 and still feel comfortable. And that means there's still room for Perth to grow by about 33%, given it's being so affordable. The other cities that could have some growth are still Brisbane and Adelaide. Sydney and Melbourne, again, it is beyond the sustainable price point. We also saw in the previous chart that the supply demand doesn't look too good for Sydney and Melbourne, so they don't look too good overall in terms of investing within the next few years. If you're looking for a capital city within the next few years, the one that's going to perform very well, I think it's going to be Perth based on the data that we're seeing. But we'll have some good growth in Brisbane and Adelaide as well. So that was just a quick summation of what we could expect in the capital cities. And I hope you found this information useful. If you got any questions, just feel free to reach out to me. Thank you.